Alternative property investing is really a reference to strategies which sit outside the norm. Hey everyone, welcome to another episode of Freedom Warrior, where it's my goal to share with you the latest insights, tactics, and strategies around alternative wealth building. On this episode, what I really want to do is go deep on one specific strategy that lives in the world of alternative so that you can better understand how this might be applied in your life. For those of you who'd like to learn more about financial freedom through alternative methods, head over to my website, freedomwarrior.com.au, where you can access my library of articles, interviews, and programs to help you on your way to becoming more financially free. Now, let's get on with the show. So one of the things that's really important to understand is maybe the distinction between alternative and traditional investing. I know I've covered that in a past episode, but I just want to touch on it again here. So alternative property investing is really a reference to strategies which sit outside the norm. And the normal strategy being that where you see a property, you don't want to contribute the full funds to that property. So you get your deposit, you apply for a loan with a bank, the bank gives you the difference, and then you go and purchase that property. Now, generally speaking, you then owe interest and principal repayments back to the bank, and you will earn, hopefully, some kind of rental income from the property itself. Now, that strategy applies to commercial and residential traditional transactions here in Australia. Outside of that, there's this whole world of what we call alternative. Now, the reason it's called alternative is it's definitely not mainstream. Lots of people, lots of investors may have heard of some of these alternate strategies, and all of the strategies that I talk about in the alternative space, they definitely exist here in Australia. But what I really want to kind of go a little deeper on today is helping you understand why not only are some of these alternative strategies, in my opinion, lower risk, they also require significantly less money at times, higher returns, and they really pull apart that whole myth around higher risk, higher return. The main challenge that Australians have with alternative strategies is actually accessing them and finding the right people. As I said, a lot of the alternative strategies, they do exist here in Australia, but certainly the way that they're set up here doesn't make them all that palatable. I feel that lots of accountants and property developers and other property people try to structure some of these alternate property strategies here, but they often require large sums of money to get involved with. They're not for the faint-hearted, and they certainly, from my worldview, require you to take on quite a lot of risk for the upside that they're offering. So I guess where I'm going with this is, some of you may know that, I love investing in US real estate, and if done well, then there are a whole raft of strategies that you can access over there that don't even require you to have to own real estate directly. And so therefore you've got no tenants and toilets to worry about. And that is an incredibly appealing position for an investor to be in. So if I were to pick one strategy to talk about today that I think would be, very appealing to the average Australian investor, it would be the strategy where you become the bank. So there are opportunities to be the money lender. And, if any of you are familiar with the way that the Australian banks operate, you can see that they're structured in a way that they never really lose. They get paid no matter what. And if things do really go wrong, then what happens is they swoop in and take the property off your hands. And usually what happens is they've required you to put enough skin in the game so that if something goes wrong, their risk on reselling, at a discount is very, very low. So, as we go into turbulent financial times, often what happens is that the the banks actually require you to contribute more cash, and they've got more costs around putting the loan in place that they might not otherwise have. Definitely as the economy slows down or gets more turbulent, the wheels turn much more slowly in the bank, and finance is harder to come by. But the strategy around being the bank, if it's done well, what happens is that you are ultimately the one that holds the deed or the mortgage over the property, and basically whoever is borrowing that money from you has the responsibility to pay interest and principal back to you over whatever designated time. Now, here in Australia, we understand that traditional loan instruments that are used by the major banks, extend 25 to 30 years, something like that. Now, what's really interesting is in the US market, that sort of strategy is also available, where you get to come in and be the deal maker. You find a family or an individual that wants to purchase a house, and then you supply them with funds in order to make that purchase. Now, the reasons for why they would want to use you as a bank could be very varied. They could be just unable to get finance through traditional lending. They may be self-employed, but for whatever reason, they're just not able to go to a traditional bank and take advantage of whatever rates the bank has on offer. And so they come looking for, alternate finance. And if you find the right deal maker to align with, they can actually do a lot of the due diligence on the property and the deal for you, help you structure the paperwork so that effectively you can do anything from a 12-month loan up to a 30-year loan, depending on the circumstances and the situation of the borrower. Now, what's super exciting for me about these sorts of deals is the person who's acquiring the property, they're responsible for the property in the same way that a homeowner is. So you're not worried about broken taps and toilets and maintenance. You're not concerned about what goes on day to day in the management of that house, because effectively it belongs to the tenant. And if you've done a really good job on vetting, not the tenant, the owner, and if you do a really good job on making sure that the person purchasing the house is putting enough capital or deposit or skin in the game towards that property, the risk of them actually defaulting and walking away from that house is very, very low. In contrast to years gone by where the banks were either prepared to loan you 100% or 95% or 98%. I'm talking about structuring loans in this particular strategy in a way where maybe they're contributing, 30% or 40% of the value of the property. So the chances of them walking away from having put that amount of money into a deal is very, very low, in contrast to, as I said, maybe prior to the global financial crisis when, people were allowed to, as long as they had a heartbeat, they could get a loan. That's certainly not the case here. And, what's exciting about this is you're in first position, meaning if something goes wrong, you just swoop in and take the property. The other reason I really love the strategy where you're in the position of being the lender is this idea that, the sums of money involved in the US market are significantly lower than what's required here. So having been an accountant for many, many years, I've spoken to many accountants who bring those sorts of deals to the table for their clients. In other words, usually it's some kind of mezzanine finance or some sort of lending instrument, which means that a builder or a developer or a business needs urgent funding in order to complete a project, or they're looking for funding that isn't through a traditional lender. Maybe because they can't get that funding, maybe there's a time constraint. It could be for all sorts of reasons. But generally what I dislike about the way that we structure those deals here is, number one, the amount of money that they're asking you to put in can often be significant. And I've had clients who've put in, $1 million into a single lending deal where they're not even in first position, like another major bank is in first position and they're sort of going to get paid second if anything goes wrong, which I never really like. And then the other thing I don't really like is often the sums of money are tied up for extended periods of time with no income coming in. Often income accrues. And I think the third thing is that often the scale and size of the average real estate deal here is just so huge that, you've sort of got your eggs all in one basket. In contrast, if I look at the same sort of lending strategies that I look at in the US, you can invest as little as a few $1,000s, like, $5,000, all the way up to maybe $150,000. That's probably the sweet spot. So we're not talking about crazy sums of money. We're not talking about hundreds of thousands of dollars. And, there's so many ways to diversify even within that strategy. You can diversify in terms of, finding the deal maker to support that deal. You can diversify geographically. You can diversify into the type of housing. You can diversify into, market price, the amount of liquidity that goes into that deal, how many years the deal is structured over. There's so many different ways to kind of creatively structure these sorts of deals. So, the idea of, being all tied up in a single deal becomes, something that's redundant. So for those of you out there who like the idea of property, who like investing in real estate, who like the security of bricks and mortar, becoming the lender is one of the simplest, lowest time commitment, least stressful strategies that I've ever been engaged in. And if I look across my stable of trusted advisors and trusted deal makers, what I can say to you is if you find the right people to work with on these sorts of deals, then, the kind of friction around finding new deals as you have capital available kind of evaporates. It becomes a frictionless process. And ultimately, that's really what we want as investors. We don't want money to burn a hole in our pocket. If we've put aside funds to invest, we don't want to be kind of spending months and months or years finding the right deal. And so, these kinds of deals make not only a whole lot of sense, but if you do it right, they can actually speed up your investing results. I think the other thing that I really love about lending deals, which is probably very relevant to where we are right now in terms of the market, is the fact that they are very recession proof. When you are the lender, you tend to be really in the primary position, and you can obviously negotiate with your homeowner to reduce or pause payments or so on, but you're really playing the long game. You're really trying to generate an income stream for yourself in perpetuity. Now, could that homeowner turn around and refinance and go back to a traditional lender? Yes, they could. And often, I think the average is something like somewhere between the 5 to 10 year mark. The homeowner might say, well, I actually qualify with a normal bank now, so I'm going to go and refinance, and you get paid out. But if you're in the right circles, you just go again, you just find the next deal. So it is one of the most effective and simplest strategies for those people who want to be connected to real estate but don't want to deal with tenants and property managers and, managing property at a distance. Because I can tell you now, having done plenty of that over the last few years, that is the simplest way the easiest way to lose money as well. And I know people who've certainly lost their shirt in those sorts of transactions. So, guys, that's all I really wanted to cover today. I hope you found that really useful. And I look forward to sharing more alternative strategies in future podcast episodes. Thanks for listening to the Freedom Warrior podcast. First of all, if you enjoyed this episode, please don't forget to subscribe to avoid missing out on future episodes. If you're interested in fast tracking towards being financially free, go to freedomwarrior.com.au, get in touch, and look forward to catching up with you next time. Take care.